Before we explain how the Option Strategy Optimum tool calculates the option strategy margin, we need to give a definition of a margin. What is it? It is a collateral for covering the potential loss associated with the option strategy in the worst case scenario. For example, the worst case scenario for a bullish strategy is a substantial decline of the underlying stock market price. A margin can also be defined as a minimum capital requirement imposed by the regulations or a broker for trading an option strategy. Brokers cannot require a less margin requirement than the regulatory minimum, but sometimes they follow the house margin rules, which are more stringent, and therefore they can require a little bit higher or even substantially higher margin requirement. And there exist two types of margin. An initial margin, which is required for opening the position in an option strategy, and a maintenance margin, which is required to keep this position in your account. The Option Strategy Optimum tool can work in two margin calculation mode, in the initial margin mode or in the maintenance margin mode, and you should click one of these buttons to impose these modes. For example, this long put butterfly was produced in the initial margin mode, and the initial margin requirement for this long put butterfly is $70, which is equal actually to the net debit that must be paid for entering the market with this strategy. FINRA is the abbreviation that stands for the Financial Industry Regulatory Authority that was established in 2007 for regulating securities trading in the United States. Rule 4210 is responsible for margin calculations, and it uses two major approaches to margin: a strategy-based approach and a risk-based approach. The risk-based approach is also known as a portfolio margining approach, but we follow the strategy-based approach, which is used by the vast majority of brokers for margining custom accounts. It suggests the decomposition of an option portfolio into recognized option strategies, which margins are easy to calculate, and then summing them up. The role of recognized option strategy is crucial in margin calculations. That's why we will be discussing them in the next section. Recognized option strategies are of four types. These are single leg strategies, long and short positions in options, and the other three are so-called regulatory offsets. They are called in such a way because they offset the risk associated with short positions in options by long positions in options. Two-leg offsets are spreads, straddles, strangles, and guts. Three-leg offsets are just butterflies, and four-leg offsets are boxes, iron butterflies, condors, and iron condors. Regulatory offsets are also can be long or short. And if your option strategy is not recognized, it must be decomposed into recognized option strategies for margin calculation. Moreover, brokers allow recognized option strategies to be executed in trades as a set of multi-leg orders. So, recognized option strategies are needed not only for margining but for execution of trades of option strategies. Assume we decided to trade this option strategy, which is definitely not a recognized strategy. The initial margin requirement for this strategy is $6,222.80. To obtain the decomposition of the strategy into recognized strategies, we need just to click this underlined margin figure and we obtain the decomposition. It consists of two components. The first one is a single leg strategy, which is a short position in two put option contracts with a strike price of 123, and the second component is a call spread with a short position in a call option with the strike price $122 and a long position with a strike price and long position a call option with a strike price of $125. So this trade must be executed as two orders, this single leg order and this two leg order. The main point that this decomposition guarantees the minimum regulatory margin requirement. The option strategy optimum tool allows you to find a minimum regulatory margin and the related decomposition for any complex strategy. For example, assume we decided to find a maximum expected return strategy in a narrow corridor surrounding this crazy strategy. This is the code of this crazy strategy. These calls must be purchased and sold, and these puts must be purchased and sold. In total, we have 10 option contracts here, and assume that we need to find a maximum expected return strategy also with a maximum of 10 option contracts. Let us set up a corridor um, going $80 up, say, and going $80 down, and push maximize expected return. And now we have an optimal strategy, um, which expected return is still negative, but it's much better than the expected return of the given strategy. But the main point is that margin requirement for this optimal strategy is $2,799 and 40 cents. Let us click on this margin figure and we obtain the decomposition. So what it means that this complex strategy must be traded in four orders. First, one leg order, single leg order, and three two leg orders, because we have two call spreads and a put spread. If we would like to trade this tool by yourself, to try this tool by yourself, go to algorithmic.com and open your own account.